welcome to Killick & Co.'s podcast for the 9th of September. Last week we saw stock markets generally move ahead, although on Friday we did have two important factors that are influencing current sentiment. First of all, the situation in Syria continues to dominate, and obviously at the G20 conference last week, opposing voices coming out from the US and Russia did cause some intraday volatility, although it is fair to say that much of it was played out by the close of play. Really, the focus on the non-farm payroll data is important, as the jobs market data for the UK will be this week. Both central banks in the UK and US have focused on jobs as the key component to their thinking as to when interest rates start to move higher. Obviously, interest rates in the bond markets are already well on the uptick at the moment, and we'll take a look at the charts there. But it's when base rates will move in both those jurisdictions, which is occupying minds of investors at the moment. Thinking of possibly 3 years by the central banks, well, it looks like it's 18 months in the view of markets as to when rates will rise here in the UK. So, as I say, it'll be quite a telling jobs number this week. Those numbers in the US, though, I don't think will influence the view that the tapering will begin in September for the US market, and we're referring there to the meeting that takes place on the 18th of September. So whilst a slightly weaker jobs number, it is felt that tapering will begin at that point. So let's just take a quick look at the week ahead. Well, obviously, as being on Monday the 9th and focusing on Japan and China, the data that we're referring to here is already out. In fact, the Japan GDP data for Q2 has been revised up quite markedly to around 3.8%, and it was good enough for a 2.5% gain on the Nikkei index, which we'll take a look at that chart in the near term. Otherwise, as mentioned, really just trying to highlight a couple of the key factors we'll be looking forward to this week. As I say, here in the UK, it will be the jobs data. Not, in fairness, a number that moves around that wildly, so we're not expecting too much volatility on it, but an unemployment rate of 7.8% compares to the 7% target that the Bank of England has set itself before even considering the move on interest rates. So just taking a look through some of the key sort of stock markets, the FTSE 100, as I say, just rebounding into that mid-range 65.44 as of the close of play on Friday of last week. The S&P, very similar profile to the S&P chart, having shied away from the 1700 sort of limit or top during August. We've obviously seen some retracement at the moment, but steadying up, which is, I think, a pretty good performance given the impact that Syria is having on markets at the moment and some of the uncertainty. A quick focus on the Nikkei. Well, as I say, after that sort of large retracement that we saw in June, we're certainly settling into the midpoint of the current trading range there at the moment. And the economic policies in Japan at the moment certainly seeming to have positive impacts on the underlying economic data at the moment. I'm pulling up the price of oil because that is one chart that seems to be bursting through to the top end. Some risk premium being built into the oil price at the moment, and this is where it is being played out, the Syria issues, and this price that we're putting up here is the WTI crude future, and bursting through 110, so close to the year high there. In terms of yields, the US 10-year yield has been a major factor on markets since May. It did breach 3%, although has shied away, and indeed those numbers on Friday, the non-farm payroll numbers, meant quite a large correction on the US yields, rallying back to sub 2.9%, albeit that by the close of play trading just above at around 2.915. And in terms of the UK, well, we again sort of breached 3%, but just shying away a little bit from that data so far. But certainly the trend on yields still working higher, and really the ramifications for that on other asset classes still being resolved. But so far the equity market seems to be able to absorb these higher yields without too much duress. Currency-wise, well, the data that we are seeing in the UK continues to impress on all fronts. It's not just about housing, although the housing data showed that August prices were up strongly. and will pose some possible concerns for government policy and central bank policy if that gets a little bit too out of hand. But it feels like we've got a broader based recovery on our hands at the moment, with both service and manufacturing data coming through quite strongly at the moment, and is leading to further gains in the currency market. Here we have the pound versus the dollar. Just turning to some stocks of feature, BG Group, the former British Gas, this is the exploration side of the business. They have quite large interests in Egypt, and it's there that they do have some problems. Shouldn't come as too much of a surprise to markets, but some of the milestones that were put in place by the new chief executive have obviously come undone a little bit too quickly for the market's liking, and the shares trade down 4% as we speak on Monday morning. They have a capital markets day tomorrow. The idea behind this day was really just to keep the mood upbeat within BG. They did have some production problems from last year, and they were making pretty good progress in terms of rectifying the confidence there at the moment, but they couldn't necessarily have predicted how events in Egypt would have turned out during the course of this year. But it is costing them potentially up to about 30,000 barrels of oil per day during 2013. So far they're keeping targets intact for 2014, but there does run some risk of those numbers failing to meet expectations if it continues to remain volatile in Egypt. The company has got some big production coming through elsewhere in the world, so Egypt will become less of an issue going forward, but these are the sort of problems that are impacting on the business short term, and as I say, driving a 4% fall in the stock this morning. Glencore Xstrata, weekend press commenting positively there about cost savings. It looks like they're going to be doubling the synergy costs coming out of that organisation. That continues to remain a preferred play in the sector. And finally, we have covered Vodafone extensively last week. The stock, having sort of retraced back to 200, is comfortably above 210 at the moment. We consider that the stock is probably trading at a 10 to 15% discount to the fair value, taking into account the sale of Verizon. I think the two issues that still remain outstanding is, will they be challenged on the tax? And of course there is a collar on the Verizon stock at $47, and of course if the stock continues to trade below $47 over the next 6 months, it will pose a little bit of a risk to that $130 billion headline number at the moment, but largely discounted, we believe, by the 15% discount that we estimate the stock trades off to the discount to the underlying sum of the parts, so continuing to remain a favoured stock. And finally, Apple shares nudging around $500. The talk about the new product that is due to be launched this week, invitations having been sent out. So Apple may be returning to focus for financial markets this week.